So let's be honest. Many of us didn't learn about the principles of money around a kitchen table. Like that was not the topic of discussion. And if you did, I want you to put something in the chat. Let me know. Put a comment in the chat. Let me know if this is something that you guys did around your kitchen table. I will have to say this journey did not start with my dad, especially because my dad passed in 2026 in March of this year, actually. And as a conservator and a guardian, it was through this process that I began to understand the importance of having your finances in order. And so even if you have a 401k that you're consistently contributing into, there's no guarantee that life will not happen to you. So you need to make sure that you are operating in three of the buckets, all three buckets, right? All three buckets. So let me give you an example about the 401k. Now we know that the 401k does not necessarily cause loss of financial independence, right? However, relying on your 401k can leave you vulnerable if there are any insufficient savings, unexpected expenses, and it offers little flexibility in where retirement income comes from. So I want you to understand, in 2023, the average or the median 401k balance was around $15,000. $15,000. Now tell me, if you're retiring at 60, 65, can $15,000 help you survive well into your 90s? I would think not, right? And the average balance was much higher. It was about $78,000. And even so, unless you have your house paid off, unless you have your vehicles paid off, unless you have medical insurance or some type of insurance covering your life, then even $78,000 is not a lot to sustain you to, for many of us, we're looking to be alive well into our hundreds, right? If you're living right. So a 401k, it can be important. Like it is an important part of your retirement planning, right? But depending on it as your only source of retirement income may reduce your financial flexibility. Why? Because it falls into the tax bucket of tax deferred. So there's three buckets, right? There is the bucket of tax now. There's the bucket of tax later or deferred. And then there's the bucket of tax never. So again, the tax deferred bucket simply means you're postponing paying your income taxes until you withdraw the money. And this includes things like your traditional 401ks, your traditional IRAs, your SEP IRAs, simple IRAs, and many other employer retirement plans. So imagine you've saved faithfully for 30, 40 years, you retire, and now you need to live on the money you have accumulated, right? Every time you take out money out of any of your tax deferred accounts, those withdrawals generally count as taxable income. And you know what that means? That means that you are going to pay taxes on the money that you are withdrawing. So depending on how much you're withdrawing, and remember, it's not like you cannot withdraw, because there is a required minimum withdrawal that you have to have, I believe, starting around 59 and a half, depending on the type of account that you have. And if you're expecting Social Security to make up the difference, you have to also understand that the IRS uses a calculation called provisional income to determine whether a portion of your Social Security benefits is subject to federal income tax. So not only is your retirement income going to be taxed, but also your Social Security has the possibility of being taxed as well. So for many retirees, your provisional income includes things like half of your Social Security benefits, okay, taxable distributions from your traditional IRA or your 401ks, certain taxable interest and investment income, wages or self-employment income, and also any other sources of income that you might have. So let's look at an example. Let's call them Tom and Mary. Okay, we're going to call them Tom and Mary. They receive about $30,000 together in Social Security benefits and about $80,000 from their traditional IRA. Okay, under this example, the calculation results in a provisional income of $95,000. Like I said before, it's going to be half of your Social Security benefits and the amount that you're getting from your retirement income, 401k, or any of those tax deferred accounts. So notice what happens. They didn't receive more Social Security if they were expecting to use that to make up the actual gap. So they withdrew money from their retirement account, but that withdrawal affected the tax calculation. So now what do they have? They have tax on their IRA withdrawal, and they have a larger portion of their Social Security becomes taxable as well. So many people describe this as catch 22, like you're in a catch 22, meaning if you don't withdraw enough from your certain tax deferred retirement accounts when required by law, you may face penalties for failing to take the minimum required distribution, right? If you withdraw too much, then that taxable income can increase, and that may cause a larger portion of your Social Security benefits to become taxable under the current law. And so the challenge for you is to balance your required withdrawals, taxes, and retirement income needs. So the question isn't, should I save for retirement? We all know that we're going to get older and we're not always going to be able to work, right? So we do need to save for retirement. But the question is, where should I save? Where should I save? How can I build flexibility so that I have options when I retire? And this isn't something that we're discussing around the kitchen table, right? This isn't something that we're talking about, for the most part, in schools are not necessarily teaching this. So I have a book that I would love to get in your hands, and I would also love to give you a financial analysis, and it's called How Money Works, The Secret of Money. It's very easy to read, and it gives you all the information that you would need to help make sure that you are retiring successfully and taking advantage of the tax breaks that are available to you. Traditional 401ks, your traditional IRAs, your SEP IRAs, simple IRAs, and